Starting from scratch forces clarity about simplicity and discipline. With limited capital, necessary complexity becomes dangerous. A simple portfolio removes distraction and emotional noise. The goal is survival first, then steady progress built on patience and understanding. A simple portfolio begins with understanding personal temperament. Not everyone can tolerate volatility or uncertainty calmly. Design must match behavior, not intelligence. Alignment between temperament and structure prevents panic-driven decisions during difficult periods. The focus would remain on long-term ownership rather than frequent trading. Trading introduces costs, stress, and emotional mistakes. Ownership encourages patience and deeper understanding. Time rewards owners who remain calm through uncertainty. Capital protection would be prioritized before thinking about returns. Avoiding large losses preserves future flexibility. Recovery from mistakes takes time when capital is small. Protection creates confidence and stability during early stages. Diversification would be intentional, not excessive. Too many holdings dilute understanding and accountability. A few well-understood positions encourage responsibility. Simplicity improves monitoring and decision-making under stress. Each holding must serve a clear purpose in the portfolio. Assets should reduce risk or enhance stability. Random additions increase confusion. Clear purpose strengthens conviction during market volatility. Cash would be treated as a strategic position, not wasted capital. Cash provides flexibility during uncertainty. Flexibility reduces pressure to act prematurely. Waiting often creates better opportunities than constant action. Businesses with predictable cash flows would form the foundation. Predictability supports calm decision-making. Stable earnings reduce reliance on market sentiment. Stability allows patience to compound over time. Complex financial instruments would be avoided completely. Complexity hides risk behind confidence and jargon. Simplicity exposes weaknesses. Early visibility prevents large mistakes. The portfolio would remain boring by design. Boring systems survive stress better than exciting ones. Excitement fades when markets turn hostile. Discipline endures when emotion disappears. A simple portfolio benefits from clear rules that reduce daily decision-making. Rules remove emotion during uncertainty and market noise. Fewer choices lower the chance of impulsive mistakes. Structure replaces constant judgment with consistency and calm. Position sizing would remain conservative to protect emotional balance. Oversized positions magnify fear during downturns. Smaller positions allow clearer thinking. Clear thinking supports patience when prices fluctuate unexpectedly. Understanding each business deeply matters more than owning many names. Depth replaces breadth when simplicity is the goal. Familiarity builds confidence during volatility. Confidence prevents reactive selling at the wrong time. Reinvestment would be automatic whenever possible. Automation removes timing decisions and hesitation. Removing hesitation reduces errors. Consistent reinvestment strengthens compounding without emotional interference. Portfolio changes would be rare and deliberate. Frequent changes create friction and uncertainty. Stability encourages long-term thinking. Long-term thinking aligns behavior with compounding. Market predictions would play no role in portfolio decisions. Predictions create urgency and false confidence. Ignoring forecasts preserves discipline. Discipline protects against emotional overreaction. Simple metrics would guide monitoring, not constant price watching. Prices fluctuate for many reasons unrelated to value. Business performance matters more. Focusing on fundamentals reduces anxiety. The portfolio would evolve slowly as understanding improves. Growth in knowledge precedes growth in capital. Slow evolution reduces mistakes. Patience allows learning to compound safely. External noise would be filtered aggressively. Headlines amplify fear and excitement. Filtering noise protects clarity. Clarity supports better decisions over time. Simplicity keeps the portfolio understandable during stress. Understanding reduces panic when markets decline. Reduced panic preserves long-term intent. Intent drives durable outcomes. A simple portfolio depends on patience more than precision. Precision invites constant adjustment and second guessing. Patience allows ideas to work without interference. Time becomes an ally when behavior remains steady and disciplined. Risk would be defined as permanent loss, not short-term volatility. Price movement alone does not signal danger. Irreversible mistakes threaten long-term survival. Avoiding those mistakes preserves opportunity. Each position would be chosen with the long holding period in mind. Short-term thinking introduces unnecessary stress. Long holding periods reduce transaction costs. Reduced costs quietly improve returns. Understanding business cycles helps set realistic expectations. Cycles repeat, but timing is unpredictable. Preparation matters more than forecasting. Prepared investors respond calmly instead of reacting emotionally. Simplicity encourages accountability for every decision made. When outcomes are clear, excuses disappear. Accountability improves learning. Learning refines judgment over time. The portfolio would avoid leverage entirely. Leverage magnifies errors and shortens recovery time. Small mistakes become large setbacks. Avoiding leverage preserves flexibility and sleep. Cash allocation would be adjusted cautiously. Sudden shifts increase the chance of mistakes. Gradual changes reflect confidence, not fear. Confidence supports patience. Rebalancing would be infrequent and purposeful. Frequent rebalancing disrupts compounding. Purposeful adjustments maintain balance. Balance reduces emotional swings. The portfolio would favor businesses with strong balance sheets. Financial strength supports resilience during downturns. Resilience protects long-term plans. Stability enables patience. The goal remains simple throughout the journey. Preserve capital, stay patient, and avoid unnecessary action. Action feels productive, but often harms results. Simplicity sustains progress. A simple portfolio benefits from clarity about ownership mindset. Owning businesses means accepting temporary discomfort. Discomfort tests conviction and patience. Acceptance of discomfort prevents panic-driven decisions during inevitable market declines. Portfolio construction would emphasize staying within a clear circle of competence. Understanding reduces uncertainty during volatile periods. Unfamiliar assets increase emotional stress. Familiarity supports calm decision-making. Each investment must be explainable in simple language. If clarity is missing, risk is hidden. Hidden risk creates surprise. Surprise leads to poor reactions under pressure. Simplicity allows mistakes to remain visible and manageable. Visible mistakes can be corrected early. Hidden mistakes grow quietly. Early correction preserves capital and confidence. Dividend-paying businesses would be considered for stability. Regular income reduces reliance on price appreciation. Income smooths emotional swings. Smoother emotions support long-term holding behavior. The portfolio would avoid constant optimization. Optimization encourages unnecessary tinkering. Tinkering disrupts discipline. Discipline supports compounding over long periods. Asset allocation would reflect personal risk tolerance. Misalignment between risk and temperament causes stress. Stress leads to bad timing decisions. Alignment preserves consistency. Periodic reviews would focus on business health, not price movement. Prices fluctuate without meaning. Business fundamentals change slowly. Slow changes allow thoughtful responses. The structure would remain intentionally boring. Boring portfolios invite patience. Exciting portfolios invite interference. Interference reduces long-term outcomes. Simplicity creates resilience during uncertainty. Resilience supports patience. Patience enables compounding. Compounding rewards restraint. Long holding periods would be encouraged to let decisions mature without interruption. Frequent action creates noise and doubt. Time reveals strengths and weaknesses naturally. Allowing ideas to unfold reduces emotional stress and improves long-term results. Position reviews would be scheduled, not reactive. Scheduled reviews prevent impulsive changes during volatility. Structure replaces emotion with routine. Routine supports consistent behavior when markets feel uncertain and distracting. The portfolio would emphasize businesses with understandable revenue models. Clear revenue sources reduce confusion during downturns. Understanding supports conviction. Conviction prevents premature selling when prices temporarily decline. Risk would be managed by avoidance rather than optimization. Avoiding fragile structures matters more than squeezing returns. Fragility appears during stress. Resilient choices protect capital when conditions deteriorate unexpectedly. Taxes and costs would be minimized through inactivity. Every transaction carries friction. Friction compounds quietly against performance. Fewer transactions preserve returns without requiring better forecasts. The portfolio would remain flexible, but not restless. Flexibility allows adjustment when facts change. Restlessness reacts to noise. Distinguishing between the two protects judgment and patience. Learning would continue alongside ownership. Ongoing learning sharpens interpretation of results. Better interpretation reduces emotional swings. Calm interpretation supports rational decision-making over long horizons. External opinions would be treated cautiously. Opinions often reflect recent price movement. Price movement rarely reflects value immediately. Filtering opinions protects focus and independence. Simple checklists would guide decisions consistently. Checklists reduce oversight during stress. Reduced oversight lowers error rates. Consistency improves outcomes over repeated decisions. The aim remains preservation first, progress second. Preservation maintains future opportunity. Opportunity allows selective action. Selective action produces durable growth over time. A simple portfolio depends heavily on emotional stability during inevitable periods of underperformance. Underperformance tests patience and belief in the process. Reacting emotionally often creates permanent damage. Stability allows time and discipline to work together. The portfolio would avoid chasing recent winners. Recent success often attracts attention at the wrong time. Attention increases prices and expectations. Avoiding hype protects against overpaying and disappointment. Decision-making would slow down intentionally during stressful markets. Stress compresses thinking and magnifies fear. Slowing down restores perspective. Perspective reduces the chance of impulsive mistakes. Holding cash during uncertainty would be considered an active decision. Cash provides flexibility and psychological comfort. Comfort prevents forced action. Waiting often produces better opportunities than constant movement. The portfolio would not aim to outperform every year. Short-term comparisons distort behavior. Behavior determines long-term outcomes. Ignoring yearly rankings supports consistency. Simple rules would govern selling decisions. Selling requires as much discipline as buying. Clear rules prevent emotional exits. Discipline preserves long-term intent. Reinvesting dividends would remain automatic when possible. Automation removes timing anxiety. Reduced anxiety improves patience. Patience supports compounding quietly. The portfolio would remain concentrated enough to understand each position. Excessive diversification dilutes focus and accountability. Focus improves monitoring quality. Quality monitoring reduces unpleasant surprises. Risk awareness would increase with experience, not confidence. Experience reveals complexity and limits. Confidence often hides blind spots. Awareness protects capital. Simplicity keeps the portfolio manageable as capital grows. Growth tempts unnecessary complexity. Complexity reintroduces risk. Staying simple preserves clarity. A simple portfolio rewards investors who understand the value of waiting. Waiting allows uncertainty to resolve naturally over time. Acting too early often increases risk. Patience creates opportunities without forcing decisions. The ability to ignore market noise strengthens long-term discipline. Noise amplifies fear and urgency. Urgency leads to poor timing decisions. Filtering noise protects focus and clarity. Portfolio decisions would remain grounded in fundamentals rather than sentiment. Sentiment changes quickly and unpredictably. Fundamentals evolve slowly. Slow change allows thoughtful responses instead of reactions. Learning to do nothing during turbulent periods becomes an essential skill. Inaction feels uncomfortable, but often prevents damage. Many losses come from unnecessary movement. Stillness preserves capital and confidence. Each holding would be reviewed for durability under stress. Durability matters more than growth forecasts. Stress reveals weaknesses early. Early awareness reduces long-term risk. Simplicity helps maintain conviction during prolonged uncertainty. Conviction weakens when structures are confusing. Clear structures support calm thinking. Calm thinking preserves discipline. The portfolio would be designed to survive mistakes without collapse. Errors are inevitable over long horizons. Survivable mistakes allow learning. Learning improves future decisions. Consistency would be reinforced through repetition of sound behavior. Repetition builds confidence grounded in process. Process-based confidence resists emotional swings. Emotional resistance supports better outcomes. Long-term ownership encourages alignment with business performance. Owners think differently than traders. Ownership shifts focus from price to progress. Progress compounds quietly over time. The portfolio success would be judged by durability, not excitement. Excitement often hides fragility. Durability supports longevity. Longevity allows compounding to work. Long-term results improve when expectations remain realistic and grounded. Unrealistic expectations invite frustration and impatience. Patience weakens when outcomes feel slow. Realistic framing keeps behavior aligned with long-term goals. The portfolio would be reviewed with curiosity rather than judgment. Curiosity encourages learning from outcomes without emotional reaction. Judgment creates defensiveness and denial. Learning-focused review improves future decisions. Avoiding constant comparison becomes increasingly important over time. Comparisons distort perception and amplify dissatisfaction. Dissatisfaction leads to unnecessary changes. Staying focused on personal goals preserves clarity. Simplicity allows confidence to grow quietly without validation. External validation often encourages risk-taking. Quiet confidence resists pressure to prove intelligence. Resistance protects long-term consistency. The portfolio would remain adaptable without becoming reactive. Adaptation responds to new facts. Reaction responds to emotion. Distinguishing the two prevents impulsive decisions. Mistakes would be accepted as part of long-term ownership. Perfection is unrealistic in investing. Acceptance reduces emotional burden. Reduced burden supports patience. The structure would support life balance outside investing. Overtension creates stress and obsession. Balance improves perspective. Perspective supports better decisions. Long stretches of inactivity would be expected and respected. Inactivity allows compounding to work uninterrupted. Interruptions reduce effectiveness. Respecting stillness preserves advantage. Simple principles would guide behavior across changing environments. Principles remain stable when conditions shift. Stability provides direction during uncertainty. Direction supports disciplined action. The portfolio's design prioritizes endurance over optimization. Optimization invites fragility and constant adjustment. Endurance supports survival through cycles. Survival allows compounding. Building a simple portfolio ultimately reinforces the importance of temperament over intelligence. Intelligence without discipline creates unnecessary risk. Temperament protects decision-making during stress. Protection allows time and compounding to work quietly. Long-term success would be measured by consistency rather than short-term performance. Short-term performance fluctuates unpredictably. Consistency reflects behavior and discipline. Discipline sustains progress. Avoiding regret would remain a guiding principle. Regret often comes from rushed or emotional decisions. Slowing down reduces error frequency. Fewer errors preserve confidence. Preparation would replace prediction as the main advantage. Predictions fail when conditions change unexpectedly. Preparation adapts to whatever unfolds. Adaptability protects plans. The ability to wait would remain the most valuable skill. Waiting reduces unnecessary action. Reduced action lowers mistakes. Fewer mistakes compound positively. Simplicity would continue to scale as capital grows. Complexity becomes fragile with size. Fragility increases risk. Stability supports longevity. Capital growth would be treated as a byproduct of correct behavior. Chasing growth distorts decision-making. Correct behavior produces durable results. Durable results last. Patience with oneself would matter as much as patience with markets. Learning curves take time. Time rewards disciplined behavior. Discipline builds confidence. The portfolio would remain aligned with life goals, not external benchmarks. Benchmarks create pressure and comparison. Pressure distorts behavior. Alignment preserves clarity. If building again from scratch in 2026, the approach would remain unchanged. Keep it simple, protect capital, and stay patient. Quiet. Discipline outlasts noise. Time favors those who endure.